When we talk of stocks globally, we can divide this universe into two distinct types. Type A stocks comprise the bulk of the market. These stocks make up close to 90% of the companies available in India. It's unfortunate, but these companies lack sustainable competitive advantages, and hence they do not possess the ability to generate a return on capital employed in excess of the cost of capital. Because these companies are actually losing shareholder value, they therefore cannot invest in growing their business. We can understand Type A companies better by examining the price to earnings ratio. When you invest your money in a company, returns can be expected from two places. The first one is an increase in the stock price, and the second source of returns can be from a growth in earnings. If you were to invest in Type A companies, then you could only expect to make returns if the company's stock price increases. This can happen because of market cycles and periods of low interest rates. So if you were to invest in a company that doubles its value every decade, then your investment would grow at roughly 7% per annum. Type B stocks are part of the remaining 10% of the Indian market. These stocks are good companies with great brand values. Since these companies have the ability to generate an ROCE greater than their cost of capital, they actually make value for their investors who trust their money in them. Type B stocks are the investments that Warren Buffett loves. Investing in such a company would see your investment grow up to around 18% annually over a 10-year period. Now, in his latest book, Diamonds in the Dust, Saurabh Mukherjea introduces another class of business. He calls these companies his Type C stocks. These companies make up less than 1% of the Indian market, and the vast level of free cash flows that these firms generate can not only allow them to pay very generous dividends, but also allows them to reinvest in their businesses. Investing in such companies will allow an investor to grow her money every 3 years or at a compounded annual growth rate of 24% each year. So what are these Type C companies and what makes them so unique? To quote from the book, India is perhaps the only large economy where several industries are dominated by one or two players. And these dominant players make returns on capital employed that are significantly higher than the cost of capital over several decades. For instance, it is not hard to find global players who dominate their industries. Walmart dominates US grocery shopping. Carrefour dominates French grocery retailing. Toyota dominates the mid-segment car market in Japan. And Heinz dominates Europe's innerwear market. However, none of these companies make ROEs substantially higher than their cost of equity. On the other hand, there are several industries in India where one or two companies not only have a dominant market share, but their ROCEs have also remained substantially above the cost of equity for decades in a row. These are the Type C companies that Saurav wants to tell us about. So how can we find such companies? According to Saurav's book, there are a few easy ways to identify which companies can be invested in. Although the original book shows a list of close to 50 items to check on, for the sake of time, I will focus on a few of the most interesting ones. If you want a more comprehensive and detailed video on these ratios, let me know in the comments below. Advanced accounting checks, a ratio of cash flow to EBITDA. Positive cash flows from operations indicate that a company's operations are functioning well and generating the bulk of its income. A higher cash flow to EBITDA ratio means that our business is able to generate a good portion of its returns from core operations and not from lucky investments or selling of machinery and equipment. Number 2, volatility in depreciation rates. Depreciation is a non-cash charge that has a very real impact on the income statement. A company that follows good financial reporting standards will have a constant rate of depreciation for its machinery and other assets. However, if a company is trying to cook its books, we might end up seeing significant volatility in its annual depreciation rates. Number 3, goodwill as a percentage of net worth. When companies buy other businesses and intellectual property, they sometimes pay more than the fair value of the product that they are acquiring. This excess amount that is paid is called goodwill, and it can be found on the balance sheet of the acquiring company. Goodwill generally exists because sellers and buyers value their assets differently. A watch worth ₹100 in the market might be worth ₹200 to a friend. And if I sell her the watch for ₹200, her balance sheet will show an asset, which is the watch, as well as ₹100 worth of goodwill. So you might ask, why is this a bad thing? It is bad because, in order to show growth, companies might end up becoming serial acquirers. Goodwill may signify overpayment, recklessness, and a high potential for upcoming write-downs in the future. How do the company's auditors feel? The auditor is an entity that has been appointed to review and verify the accuracy of financial records of a company. This means that the auditor should be looking out for the shareholders' best interests. However, what if the auditor is being paid to look the other way? Then isn't it a big red flag that the shareholders need to be worried about? Here are some questions that need to be asked. Is the auditor being paid in line with other companies in the industry? How often does a company change its auditors? And has an auditor resigned? If so, why? Governance checks. Number 1. Related party transactions. The term related party transactions refers to a deal made between two parties who have a common interest. Companies often seek business deals with parties with whom they are familiar. Although related party transactions are themselves legal, they may create serious conflicts of interest. In the case of publicly listed companies, it is the job of the investor to make sure that shareholders are not receiving the raw end of the deal. It is often the case that promoters use publicly listed companies as customers for their own private businesses. This results in a gradual loss in shareholder equity and also sees the promoter lining his pockets with shareholder money. Number 2. Mergers and acquisitions of promoter-owned entities. Till 2008, Satyam Computer Services was counted among the top Indian IT companies. Then in January 2019, B. Ramalinga Raju, promoter and chairman of Satyam, admitted to large-scale falsification of the company's financial results. It was revealed that Raju siphoned cash out from Satyam to buy land and properties in his personal name. The Satyam scandal rocked the Indian stock market to its core and saw a large-scale evaporation in the savings of shareholders. It is therefore important to study the behavior of a company's promoters and to ensure that mergers and acquisitions are done to enhance shareholder wealth and not promoter wealth. Checks for competitive advantages. Is the ROCE greater than the cost of capital? The return on common equity is a measure of how much money common shareholders receive from a company compared with their original investment. A higher percentage means that shareholders are receiving a greater return. Cost of capital is a company's cost of funds. It is the minimum return that would be necessary to justify the undertaking of a project, such as building a new factory. If a company's ROCE is less than its cost of capital, it means the company is losing money on new projects. That is, it is destroying shareholder value. So instead of spending money on factories and new offices, the company should instead return money to its shareholders in the form of buybacks and dividends. Number 2. Does the company have brand value? What makes HDFC Bank the number 1 private bank in India? When I say noodles, why does the word almost seem incomplete without adding Maggie to that phrase? Why are all of the Tata brands synonymous with trust and reliability? And how come no matter where you look in India, the Royal Enfield Bullet is one of the most coveted motorbikes? Companies like the one I mentioned above are known for their products. In fact, their own customers will swear by them. There is tremendous aspiration to one day ride through the streets in a Bullet, and every school child drools at the thought of having a bowl of Maggie after a hot day in the sun. Well, at least I know I used to. When a company has such great brand recall, it doesn't even need to spend much on marketing the product to the public. Praise for the company goes around like wildfire, and its products will sell themselves. When looking at great companies, it is therefore important that we also examine the brand value of these businesses as well. Number 3. Does the company have sustainable competitive advantages? As you probably guessed, brands with high value but no sustainable competitive advantages will fade away with time. The best 1% of companies are constantly innovating and improving the way they do things. They invest heavily in the best kind of resource, which is human capital, and are always looking for 1% incremental improvements in everything that they do. When you begin to add up small 1% improvements over time, the company becomes more efficient, decreasing its cost of capital and even improving its ROCE. Over time, customers will notice that you have a superior product to sell, and your brand value will also grow several fold. Whew! So that brings us to the end of this week's cup of coffee. Let us summarize what we covered in this video. Type C companies are the diamonds hidden in the dust of the Indian stock market. These are the companies that have the ability to effectively reinvest their earnings and create large-scale profits for their shareholders. Identifying these companies is not easy, but if we study these Type C businesses, investors will begin to notice that they have a few points in common. They generally have great earnings quality that is generated by revenue growth and not sale of assets or overly aggressive acquisition strategies. These companies are run by professional managements who put the welfare of shareholders first. A strong value system ensures that these businesses have effective corporate governance with the right checks and balances in place. These companies do not want to rest on their laurels and invest heavily in improving their brand value as well as their human capital. And with that, we come to the end of this week's video. But that was not it from Saurabh. Please check out his latest book, Diamonds in the Dust. It is a beautifully written gem. I hope that you enjoyed this week's cup of coffee. Don't forget to like, share and subscribe if you love the content that you see here. If there are any specific topics out there that you'd like to see in the future, please do let me know. And if you like the content that you found here, check out my other videos on investing and finance as well. As always, we are always open to any tips and suggestions that you may have in mind. Keep smiling, and until we meet again, this is Filter Coffee Finance signing off.